the obvious, there continues to be a broad negative overhang on the lithium and energy storage space as we move into the second half of the year. Lithium prices moved lower in the second quarter and have declined further third quarter to date, testing new lows in this cycle. There are a few dynamics we can point to that are contributing to this price weakness. Touching briefly on demand, it's safe to say that while there's been some recent pullback in near-term US and European EV demand growth globally remains robust. On a gigawatt-hour basis, total EV and PHEV sales were 20% higher year over year in the first half of this year. Underlying growth in China, where the bulk of lithium demand resides today, remains strong, with EV sales exceeding 1 million units in the month of June, and penetration rates continuing to set all-time highs. Additionally, demand growth for stationary storage applications continues to be a rapidly growing part of the future total demand picture. In aggregate, there's been very little fundamental change to the long-term demand trajectory for lithium, and this growth is going to continue to require meaningful additional supply to come online if the market is going to be in balance. However, we clearly don't have that balanced market today. Additional lithium supply has come into the market at a faster rate than many of us had expected. Much of this supply growth has come in the form of spodumene out of Africa and lepidolite in China, which is much higher cost than most existing supply. But much of the investment in these resources is coming from supply chains directly connected to converters or end consumers in China, as they seek to become more integrated into upstream resources as part of their strategy of establishing long-term security of supply. This is resulting in lower demand growth for unintegrated spodumene, even as end market demand for lithium chemicals continues to grow. It also reduces the demand for some lithium chemicals, as more consumers or fully integrated converters in China are now producing lithium chemicals themselves. Put differently, while the volume of lithium chemicals being processed into the battery supply chain continues to increase at double-digit percentages per year, the market for non-integrated spodumene concentrate and lithium chemicals has not been growing at the same rate in recent quarters. Despite this slower external demand growth for lithium products, we've seen spodumene producers in particular continue to increase both their production and shipments of spodumene concentrate. Our own marketing of small volumes of spodumene concentrate from Mount Cattlin shows that the demand for material remains broad, with over 20 bids received for our latest market testing auction. However, the increase in supply appears to be even greater than this broad demand can absorb, leading to more downward pressure on spodumene prices. And history shows us that when spodumene prices are low, lithium chemical prices in China are also going to be low, and that is certainly the case today. To compound this, we've also seen supply of lithium carbonate from South America continue to grow, albeit at slower rates than the growth in spodumene supply. As a result of this increased supply, we see higher levels of lithium carbonate and spodumene concentrate inventory in the market right now. Much of this inventory is being held by traders and through futures exchanges, where activity is increasing, rather than at producers or at end customers. The greater customer and converter integration and a greater willingness of intermediaries to buy and hold material, combined with the continued flux in technology roadmaps of global OEMs, is resulting in less visibility for lithium producers into true underlying end market demand than we have had historically. It's easy for producers today to see end-use consumption continue to grow, see this as a proxy for market demand for lithium chemicals. However, the evidence suggests that in today's environment, this connection is not holding true in the short term. Despite this, we view longer-term lithium prices as heavily skewed to the upside from today's levels, as there's limited ability for prices to move much further down from current levels on a sustained basis. But in fact, we believe that prices in China today are well below the cost of the marginal producer, significantly below the prices needed to incentivize further investment. The longer prices stay where they are, the greater the likelihood of production curtailment from high-cost resources, lower the investments in future supply. We expect that end market demand growth rates and lithium chemical demand growth rates will return to alignment as the pace of back integration slows, and this will result in prices increasing towards reinvestment levels at that time. While we have seen more announcements today of slowdowns and delays from both incumbent producers and junior developers, we do not expect these to materially impact the market in the next few quarters. However, we do believe that the forecasted supply for 2026 and beyond in most independent models is much too high given the impact of these slowdowns. We expect to see more discipline from producers and less freely available and more expensive capital, especially for those projects that are not backed by existing cash flow or are being developed by companies without a proven track record of success. We also do not believe that lepidolite or African spodumene volumes can continue to expand at the rate we've seen in the last few years. And perhaps just as important, financial logic of downstream conversion of raw materials into higher value products, especially outside China, will face much higher challenges, resulting in a very tight market for lithium hydroxide that is not sourced from China. We remain confident in a return to healthier market fundamentals over time, as well as in the world-class development projects available in our portfolio. However, we must adapt to the realities of the market we find ourselves in today and the pace at which we can responsibly invest capital on that basis. Arcadium Lithium has therefore made the decision to pause investment at the Galaxy project in Canada. This remains a world-class resource, leading fundamentals, and a projected operating cost that will be amongst the lowest spodumene assets in the industry. However, we do not believe that the market needs us to bring this volume online on a merchant basis within the next 2 years. And as I just mentioned, the current economics of building carbonate or hydroxide conversion capacity outside China, absent a very strong long-term customer commitment, are not compelling. We're currently exploring bringing in a partner that is interested in providing capital for the Galaxy project in return for a long-term strategic investment, likely backed by a long-term supply agreement. The pause will be structured to minimize the cost and timing disruption when this project is ultimately restarted. Additionally, Arcadium Lithium is revisiting the sequencing of its combined 25,000 metric ton lithium carbonate projects at the Salar del Hombre Muerto in Argentina, between Phoenix Phase 1B and Sal de Vida Stage 1. These projects are also industry-leading, with forecasted operating costs firmly in the first quartile for lithium carbonate production. However, rather than execute both expansions simultaneously as previously announced, the expansions will now be completed sequentially. Doing this will also provide additional time to evaluate how to optimize future development of the Salar del Hombre Muerto complex, where the two projects sit within a few kilometers of each other, especially with respect to the additional infrastructure investments that will be needed for future expansions. It will also allow us to spread the capital spending over a longer period of time. We are not changing our plans for the development of Nemaska Lithium, the 32,000 metric ton integrated spodumene to hydroxide project in Canada. The combination of our progress made to date and the strong customer commitments we have in place for the project give us confidence in continuing to push forward towards commercial production. As a result of our decision to defer investment in 2 of our 4 current expansion projects, as well as the process of identifying cost-saving opportunities in our remaining projects, we expect to reduce our capital spending by approximately $500 million over the next 24 months. These decisions do not reflect any change in our view of the attractiveness of these projects. But in today's environment, we will focus on cost discipline and operational execution that continues to differentiate the performance of our business in this market, as well as on responsible capital deployment as we navigate through low market prices. Our portfolio of operating and development assets remains core to the value and future of this business, and we intend to provide a detailed review of our expansion plans, financial outlook, and broader strategic objectives at our upcoming Investor Day on September 19th, with further details on this event to follow.